So, amalgamation comprehensive illustration, A limited and B limited. A new company formed to take over A and B. Right, that's how we studied in the previous class. We have calculated the purchase consideration for A as well as B. The purchase consideration for A being 1900, and then the purchase consideration for B being 1000. And the point to be noted here is any amount payable to the debenture holders will be nothing but part of settlement of debt, not part of the purchase consideration. So here is 12.5%, here is 12.5%. So these two will be separately included. Now we'll just close the books of accounts. Here we have been given preference shares also. As both the companies are closed and new company AB is formed to take over company A and B. So now I will just prepare the ledger for closing these two companies. Okay, that too in columnar form. Okay, so nothing stated, so I may simply close the books of A limited and B limited by preparing the ledgers and straight away then pass the journal entry and prepare the new balance sheet. I'm not going to pass the journal entry for the closure of the books. Right here, realization account for both the companies. I can use the columnar form. Okay. Realization account and purchasing company account, purchase consideration account and purchasing company account AB. Purchase consideration payable by AB not only in the form of equity shares, it has multiple forms: equity shares, preference shares, some cash, some debentures and all offered to equity shareholders. And we have the preference shareholders also, so it's better to open one more account called preference shareholders account. Post the items available in the balance sheet to the concerned ledgers so that it will be closed. Yeah. Close the books of accounts. Equity share capital transfer to the equity shareholders account. So by equity share capital 1500, preference share capital to the preference shareholders 400 and 200, resource and surplus nothing but profit and loss 200 for A as well as B. Non-current liabilities, a part of liability will be shown in the credit side of the realization account. So this will be for A, this will be for B. 10% debentures, value being 200 and 100, current liabilities being 200 and 200, non-current assets 1200 and 800, Current assets being 800 and 400. Clear? Then we need to incorporate these details. Here is another 12.5% for this company. This is for this company. Another 100 rupees is for this company. I am going to incorporate these details. Yeah. The purchase consideration for company A being 1900. So purchase consideration 1900. For B it is 1000. Will be transferable to the next account, purchase consideration, here realization account 1900 and 1000. This amount will be payable by AB. So now I am passing the due entry 1900 and 1000. Transfer that to AB, purchase consideration 1900 and 1000. And then the mode of payment of this purchase consideration being by way of equity share capital of AB, the value being 1000 for A company shareholders, 500 for B company shareholders, and cash is also offered 500 rupees for A company shareholders, no cash for B company shareholders. Preference share capital also offered 15% preference share capital. For A company's preference shareholders, they will be getting 400. For B company's preference shareholders, they are getting 160. Apart from that, 12.5% debenture, I think it should be 12.5% debenture, being 340 offered to shareholders of B company. This 340 being the part of purchase consideration because it is payable to the equity shareholders. Anything payable to the equity shareholders or preference shareholders are considered as a part of purchase consideration. Even though if you are paying equity shares to the debenture holders, it's only settlement of debt. Should be careful. Okay. And these mode of payment will be now distributed to shareholders as well as preference shareholders. Preference share capital will be distributed to the preference shareholders. So this is preference share capital of AB. To distinguish between the existing preference share as well as debenture and preference shares of AB. I represent AB in brackets here. And in A, 400 rupees is offered. For B, 160 is offered. Leaving that, rest of the other things is for the equity shareholders. So here, equity share capital of AB offered to the equity shareholders of A being 1000, the equity shareholders of B getting around 500. Not only that, the bank amount settled by AB is also be given to the shareholders of A. No such case for B. And a portion of pending amount is settled by way of debentures. That will be only for the equity shareholders of B. Clear? Now, close the books. By closing this book, we came to know 40 rupees balance is there in preference shareholders account. This balance is nothing but profit for the equity shareholders. Will be transferable to the realization account or can be directly transferable to the equity shareholders account. So either way you can show. Anyhow, I just transferred that to the realization account. Okay. So in realization account, gain by settling to the equity preference shareholders being 40. That too, the gain is due to the settlement of the preference shareholders of B company, not for A. By transferring this 40 to the credit side of the realization account's profit may be inflated. That inflated will again ultimately transferable to the equity shareholders. Rather than that way, this 40 can be directly transferred to the equity shareholders also. There is no any harm in that. Is that clear? Now let's try to finish up the realization account. So here, by tallying this, you will find any profit or loss on realization. I think you get profit only 2300. Come on, get me the answer by working. 300 rupees will be gaining for A, 1340, 1340. 140 is a gain on payment to the B, transfer up to the equity shareholders of the concerned company. Here, realization account profit. For A, 300, for B, 140. So finally, if I tally this, it will be automatically tallied 1500, 1500. Here being 840, 840. Clear? Rather than this way, if you transfer that 40 here, you show the 40 here, you reduce this 40. Naturally, if you reduce 40 in the credit side, the profit will be reduced to 100. It will be shown as this way, 100 plus 40. That way also you can show, no harm in that. Is that clear? Hope now you will be able to understand all this component. Now I'm going to pass a journal entry in the books of SSA and means the journal entry. I think you can pass it yourself. That's very customary only. I may pass a journal entry for means incorporating these assets and liabilities in the books of purchasing company. Okay. So while passing this entry, I may follow either purchase method as well as pooling of interest method. So both the method I can follow. Right. So various assets and liabilities are taken over. Various assets and liabilities are taken over. Now, we'll start with the first one. I think I don't have any revaluation of assets and liabilities. For, yeah, of course, there is a revaluation of assets and liabilities, right? No information regarding the revaluation of assets and liabilities. Illustration number 6 only, no? Yeah, okay. For B, we have been given goodwill. Revaluation happens for B only. For A, of course, there is no information regarding the assets. So, I'll take the revaluation value, realizable value today for the preparation of purchase method, book value in case of pooling of interest method, right? Let me start with the purchase method. Purchase method. Under purchase method, we have to find out the payment method, payment amount here and debit to the business purchase account. Business purchase account debit to liquidator of A to liquidator of B. Amount payable to A and B being 1900 and 1000. 1900 and 1000. Overall amount payable being 2900. Purchase consideration for both the company. This business purchase is now replaced with all the assets and liabilities at the realizable value. So what are the assets we have? Okay, we have non-current assets and current assets to 10% debentures. 10% debentures taken over and we replace with new 12.5% debentures. Right. So first you start with the debenture taken up. Two ways of solving this is there, but I'll now follow with the traditional method. Take absolute value of assets and liabilities to your books, where the 10% debentures are taken at 200 plus 300, 100, 300 rupees, and to current liabilities. I think we don't have any value change for these things, isn't it? So, tangible assets of the next company, B company being 1200, tangible assets, total assets, already it is only 800 plus 400, 1200 only, there is no any change. Only one new item is introduced, which is the goodwill. So we can calculate that goodwill part later on, not now. Let me finish up incorporating other details here. I hope, though I am going to show at realizable value, there is no any change in the value between the books and the value appearing in the books as well as realizable value actually applicable in the market. So we assume the value will be absolutely taken here, 1200 plus 800, 2000 rupees for the non-current assets, 800 plus 400, 1200 for current assets. Current liabilities being, already we have taken the 10% debentures for 300 rupees, current liabilities being 200 plus 200, 400 rupees, there is no any value change. The original amount payable to them is business purchase, 2900. Cross verify whether the debit is equal to the credit side or not. So 3200 rupees being the debit side value total, and credit side we have 3600. 400 rupees shortage is there now, so we have no other choice. We have to show this being goodwill. We have to show this being goodwill. Okay. So goodwill in this case being 400 rupees. Clear? Goodwill. Now, we have to pass the entry for settlement of these three values, these two values. Not only that, this is also be replaced. The A company's debenture holders and B company's debenture holders simply surrender their debentures, and the AB now issues their own debentures. While issuing the debentures in exchange of the existing 300 rupees worth of debenture, they offer only 160 and 100, 260. Originally, the debenture holders are in need of 300 rupees to be settled, but we are paying only 260. There is a 40 rupees shortage. As there is a 40 rupees shortage, that 40 rupees shortage is, we are paying lesser, is gain for us. The gain will be named as either capital reserve, or if already there is a goodwill, can be subtracted. So the entry being 10% debenture is going to be cancelled, account debit, the value being 300. For that, we are offering to 12.5% debentures. This value being 260 only. We gain 40 rupees. Usually gain is capital reserve, but already we have the loss named goodwill. That goodwill can be written off to this extent. Now goodwill is reduced from 400 to 360 after adjusting this gain. So now we close the payment to the debenture holders. Now we'll go for settling the liquidators of A as well as B. Liquidator of A as well as liquidator of B. Liquidator of A, debit. Liquidator of B, credit. Sorry, debit. The amount payable to the liquidator A being 1900 and B being 1000. The mode of payment to these two liquidators being equity share capital. The equity share capital of this company, 1000 plus 500, 1500 for both the liquidators put together. Apart from that, preference share capital is also offered, which is 400, and here is, we have 160, so 560. Apart from that, a portion bank payment is also made, okay, which is around 500 rupees. 500 rupees, and debenture is also offered to 12.5% debenture. I think the percentage is 12.5%. Cross verify this, which is 340. Now check whether the total is matching or not. I think the total being 2900. Clear? Sir, what about the goodwill we have been given, sir? The goodwill is not a matter in the case of purchase method. Okay, we value the goodwill being 1 lakh is only for determining what is the net worth for them to determine the purchase consideration. Once it is over, the ultimate goodwill may be different. The ultimate goodwill is not only that 100 rupees, there may be some other loss. For that loss also, it will be named as goodwill. Clear? That goodwill is not going to be considered. Now, let's move on to the pooling of interest method. Under pooling of interest method, first entry being the same, only this entry will be different. So you can combine these two entries also, no problem. In Singar Academy text, I think I have combined these two journal entries. How can you combine? remove the 10% debentures, then automatically to current liabilities to 12.5% goodwill in credit as well as goodwill in debit mutually cancel and becomes 360. That's how it is shown in the Singar Academy text. You can pass two journal entries. We have taken the debentures of the selling company. Thereafter, we offer our debenture in exchange of their company's debenture. That way also you can solve. Under pooling of interest method. Okay, pooling of interest method. So, in case the amalgamation being the merger, we have to apply the pooling of interest method of accounting. So, pooling of interest method is nothing but line by line additions where the assets and liabilities are recorded its own book value. And actually, the entry will be different only in this case. Rest of the two entries are same. Rest of the two entries are same. I can simply copy paste this here. Okay. Clear? So, I am going to make change only with respect to the second entry. Okay. These two entries are same. And here I am going to make the change. Non-current assets, I have to show at what value? Book value. I have to show at book value. You understand the difference? Here book value as well as realizable value both are same. I just take as it is. Current assets, debit 1200 to what we offer 12.5%. I am merging these two entries. 12.5% debentures being 260. Okay, I merged this. Okay, and to current liabilities 400 rupees. Don't forget to show the profit and loss account also. The profit and loss account of these two transferor company being 200 and 200 each, so 400 rupees. Okay, you can show here 300, no problem. If you show 10% debentures, the debentures of A and B as 200, 300 rupees, later on settlement you gain. If there is any profit or loss and under pooling of interest method, that will be adjusted only in the reserves and surplus P&L account only. Now, business purchase, the value being 2,900. Cross verify whether debit credit are tallying or not. $3,200 being the debit side value, credit side value being 3,960. So almost 760 rupees shortage is there, right? 760 shortage is there. That 760 should be subtracted from this. If I subtract, then what happens? Your profit and loss being minus value being how much? 360. Clear? Okay. While posting in the ledger, means balance sheet, you show the 360 under equity only. Resource and surplus, put the value in the brackets. Is that clear? Hope now you will be able to understand this one. Shall I solve this? Can I go for the balance sheet? Okay. So in case of balance sheet, first we'll start with the purchase method. Balance sheet. Business purchase got eliminated. Liquidator of A and B in the credit is equivalent to debit will be mutually cancelled, and 10% debenture, 10% debentures also be cancelled. Okay, leaving that, we'll start with the equity and liability. Under equity and liability, what we have to do? Equity shareholders funds. Under that, equity share capital being 1,500, preference share capital 560, profit and loss, of course we don't have the profit and loss. Apart from that, non-current liabilities, debentures 260 and 340, total debentures being now 600. Am I right? Then we have current liabilities 400 rupees. And in balance sheet, asset side, start with the non-current assets, intangible assets, goodwill, and other tangible assets. Goodwill being 400. 400. After set off this 40, you will get only 360. Other tangible assets being 2000. And in current assets, 1200, where there is a payment of 500 rupees, right? So hereafter the current assets being 700. Bank is also part of current assets, we assume. The existing current assets may be inclusive of a bank, so this is adjusted there. Now the total being 3060. 3060. What happens in case of pooling of interest method? Under pooling of interest method, business purchase got eliminated. Liquidator of A and B got eliminated. Right. So now equity share capital being 1500. Preference share capital being 560. Bank will be adjusted with the current assets, so 700. Profit and loss will be maintained intact, but it's in debit side, so profit and loss, reserves and surplus. 360 in negative. 12.5% debentures, 260 and 340, 600. Current liabilities remains as it is 400. Non-current assets being 2000. We don't have the goodwill here. The total being 2700 now. Is that clear? Hope now you'll be able to understand easily the difference between purchase method and pooling of interest method. Shall I move on to the next one? Okay. Text me, online students, come on. Make it faster. Now, next question, intrinsic value method. Continue with the previous problem. Calculate purchase consideration using intrinsic value method, otherwise named as share exchange ratio method. Company A Limited will take over Company B Limited. So here absorption type, A takes over B. Thereafter B will be closed, A will continue. Right. Now for intrinsic value you need to find out the net assets worth. Okay. So we'll start with this balance sheet. The same illustration. Right. B Limited has goodwill 100. Goodwill. A Limited and B Limited. We have not been informed any goodwill for A, so we have goodwill only for B. The fixed assets of A Limited and B Limited are increased by 10% and 5% respectively. 10% and 5% respectively. There's an increase. Non-current assets, otherwise fixed assets. So 7,000 with the 10%, 7,700. 3,000 plus 5%, 150, 3,150. The current liabilities of A Limited are decreased by 5%. There is an unrecorded liability of rupees 50 in B Limited. So for first company, 5% decrease is there. For the second company, there is increase by 50. Nothing stated with respect to the current assets. So we assume the book value will be equal to the realizable value. So I'll take as it is 3,000 and 2,000. Now the total of the assets being 10,700, 5,250. Now I have to subtract the liabilities. Is that same illustration? So I've chosen wrong illustration. Okay, sorry. Okay. So I shifted to that page. So I got confused. Okay. Yeah. This is the information. I'll keep it here. So of course we have the goodwill here. Non-current asset increased by how much? 10 and 15. 10% and 5% increase. 1,200 plus 120, 1,320, 805 percentage being 40, 840. No information regarding fixed current assets, so I'll take as it is 800 and 400. 800 and 400. Okay. Then, in case of current liabilities, 5% decrease for the first company, 50 rupees increase for the second company. Apart from that, we have been given debentures also. Non-current liabilities being the debentures 200 and 100. In case of current liabilities for A, realizable value being 200, 5% should be subtracted, 190. Similarly for B, 200, but there's an increase by 50, 250. Okay, the total of the liability side being 350 for B, 390 for A. Total of the asset side being 2,120 and 1,340. Am I right? Cross check. 1,340. Okay, we are taking at realizable value. Now net worth of the company is nothing but the asset minus liabilities. So this will be A, this will be B. You are subtracting this one from here. So first case, what is the value? 1,730. Second case, 990. 990. How many shares are there? You have to subtract the preference shares also. Sorry, we have been given preference shares because I am going to calculate what is the value per equity share. So in that case, preference share should also be removed. So only we will be finding the value meant to only for the equity shareholders. I have not noted that. So now I am going to subtract this one. Preference share capital, which is 400 and 200. The ultimate value for the equity shareholders being 1,330, 790. This is called equity. Equity is nothing but equity shareholders funds. Now what is the number of shares they have? Number of equity share capital. 10 rupees each for 1,000 means automatically 100 shares or 100,000 shares and 50,000 shares. And what about the intrinsic value? Fair value per share. Okay, which is nothing but equity value divided by number of equity share capital, then the value being 13.3. And in this case, come on, get me the value. 15.8. 15.8. Then what about the share exchange ratio? 15.8 is to 13.3. So from this it's very clear. A will offer higher shares for B. For B. 15.8 shares offered for every 13.3 shares of B. Because B shares price is higher than A shares price. So naturally, A has to give more share. For every 13.3 shares, A will give 15.8. How many shares are there for B? 50 shares. 50 shares means how many shares are going to be offered by A? Okay. Purchase consideration in terms of number of shares. Number of shares. Okay. So 50 into 15.8 divided by 13.3. What's the number of shares you are getting? 50? 59.4. So purchase consideration in this case being 59 into 10 rupees 590 in the form of equity share capital. For the fraction, they have to offer in cash. Okay, zero point 0.4 share per share value in A company share being 13.3. What happens? A company offers their share. A's company share value being 13.3, and the number of A company shares seems to be fraction here being 0.4. So 0.4 into 13.3. What is the value? 5 point? Otherwise 5 rupees. So 595 will be the purchase consideration. Of course, if you want to include the securities premium, you can do so. If you want to include the securities premium, 59 into the value in exchange means excess than the face value will be considered as your premium. Not required, not required, but you can give the hint. I have not considered the securities premium as a part of the purchase consideration. Is that clear? Hope 595 will be the purchase consideration. In this case, payable by the transferee company to the transferor company. A should pay to B this much. Shall I move on to the next one? If you want to copy, you can copy this because I have not given the solution in text. Amalgamation with intercompany owing as well as unrealized profit on unsold stock, where stock sold by transferor company. Right. Gold Limited, transferee company, and Silver Limited being the transferor company, amalgamate in exchange of the stocks from Gold Limited. So silver is now merged with gold, and for that stocks are offered. And the pre-amalgamated balance sheet of the respective companies are as follows. And the balance sheet items are given in notes to accounts also. What are the requirement here? Past journal entry in the books of Gold Limited. The basic three journal entries. Prepare post amalgamated balance sheet under pooling method as well as purchase method. So here what happens? You forget about the transferor company. You no need to prepare the realization account and all, and you no need to pass the journal entry. Most of the cases, this will be the most important component. You need to pass the journal entry only in the books of the transferee company. Sometimes you may be asked to prepare the balance sheet also, right? Here we have been asked to solve under pooling as well as purchase method both, right? And also it's all about share exchange value method. The special points to be noted here is all about amalgamation with intercompany owings as well as unrealized profit on unsold stock. So these two cases you have to handle it, right? So in the very beginning itself, I have given all the details. So practical questions, calculation of purchase consideration, related questions we have studied. Basic problem for absorption. Either it may be purchase method or merger method. How can we solve? We have completed. And in case of amalgamation also we have studied. So in case of absorption, A company takes the other company. In case of amalgamation, both the companies closed and new companies formed. And of course, we have studied the comprehensive problem for amalgamation as absorption as well as amalgamation under both the method, purchase method and merger method. And we have incorporated the AAA amalgamation adjustment account. In case of statute reserve, you have to pass the entry for statute reserve in the books of in the case of purchase method, not for the pooling of interest method. Now we have to study the sixth element, unrealized profit on unsold stock. Usually it is interconnected with the intercompany owings. Is that clear? Now, what is called intercompany owings? What is called intercompany owings? Company A, company B. Okay, company A, company B. In debtors of A being 1000, where the debtors include B 200 rupees. In case of B, they too have the debtors 500. Apart from that, creditors, okay, creditors being 500. Here, creditors being 400. What does it mean? A says my debtors being 1000, from the debtors 200 rupees recoverable from B. Recoverable from B. Am I right? Naturally, B has to say 200 rupees payable to A. So, out of the total 400 rupees creditors, amount payable to A being 200. That's how he shows. What happens in case of a merged one? A, B are integrated. These two companies are integrated. In case of debtors, what do you do? 1000 and 500, 1500. And in case of creditors, 500 and 400, 900. There is no any problem here. But what happens here? This debtors includes amount recoverable from B 200, and this creditors includes amount payable to A 200. Now these two parties are not existing. These two are merged. Mutually now you cancel the 200 here. By cancelling, the debtors will be reduced to 700 and this 500 is reduced to 1300. The simple journal entry in this case being to cancel the debtors should be credited and debit the debtors to the extent of this amount. Is that clear? By passing this entry, finally, where only in the transferee company after passing the 3 entry, this entry will be passed for the intercompany owings. A company has to pay to B as well as recoverable from B. In that case, you can pass this entry to eliminate this. Okay. This is called intercompany owings. Hope you will be now able to understand. Any doubts here? So, in case of intercompany owings, debtors and creditors and debtors, that's how we can pass the journal entry. Intercompany owings not necessarily only because of the debtors and creditors, it may be BR and BP. Okay, as well as any loans and advances. Okay, for example, the balance sheet of A as well as B. A as well as B. Clear. So, A says my BR being 1000 and here also there is a BR being 500 rupees and bills payable. For A it may be 300 and for B bills payable being 250. Is that okay? Now A says this BR includes the amount recoverable from B being 100. Okay, for A, B being the payer should pay later period. Until that period, it's a part of BR. In case of B, amount payable to B, A being included here, right? Isn't it? What about this value? 100, not necessarily 100. Maybe higher than 100 also, maybe 150. Is that okay? Either the same value or it may be higher value. Why? Why? B has accepted to pay 150 rupees by way of bills payable and it is BR for A, right? A may keep it till maturity and encash it later on rather than A can simply endorse to third party, one of the creditors, or he can simply discount that with the banker. In that case, C, A says bills payable, means B says bills payable to A being 150, but A says only 100. The difference between these two 50 may be discounted or endorsed. Discounted or endorsed. In that case, while merging these two, preparing a new balance sheet AB after the merger one, BR 1000 plus 500, 1500, and BP 300 plus 250, 550. Where the mutual amount to be cancelled here is mutual owing related to the BR and BP being lower of these two, 100, and here 100, 450. What about the another 50, sir? B says it is payable to A says that bill is given to C. Now, after the merger, this 50 becomes amount payable to C or amounts payable to the banker. So, it is not mutual owing. This value becomes third party owings on merger. Clear? That small point you have to understand in case of BR and BP cancellation. Okay. So in BR and BP, bills payable is cancelled by debiting. Usually bills payable is a credit balance. To cancel it is credit debited and BR is credited. The amount should be the lesser of BR and BP, considering bills discounted and bills endorsed. Is that okay? That's the logic. And you have to keep that in your mind for bills receivable as well as bills payable. Is that clear? And then the third one is all about loans and advances and borrowings. Loans, advances and borrowings. The same. This is similar to the debtors and creditors, so I no need to explain this. Okay, the loan usually liability, advances may be the asset. So advances, asset cancelled by crediting and loan cancelled by debiting. So loan upon debit to advances. Or borrowings debited, loans and advances may be considered as asset, can be credited. Okay, clear? Hope so you could now understand intercompany owings logic. Okay. Now let's move on to the next one. If it is clear, text me so that I'll move on to the next one. Now what's about unrealized profit on unsold stock? Okay, in the books of purchasing company. A company sells the goods to B, or okay, sales made by A to B or B to A. In either way you can think. So in his balance sheet as well as in his balance sheet, stock 1000 rupees. Stock 1000 rupees. Now B sells 500 rupees worth of stock to A by adding his markup profit 100. Naturally, stock will be reduced to from 1000 to 500, and automatically it gives a rise to the profit for B. In case of balance sheet of A, new stock comes at what rate? 600 rupees. At 600 rupees. Am I right? Clear? So, A says that I purchased 600 rupees worth of goods from you. So, I am going to show that 600 rupees as the stock's value in my balance sheet. That's his asset. The amount what I pay for purchasing the stock is my asset. And B says, I sold 500 rupees worth of goods for 600 rupees. I knew that it's my trade practice to add 100 rupees profit for the goods sold. So, 500 rupees stock has gone down. Automatically what happens? Here after the reduced stock being 500, there's a profit of rupees 100. Naturally, if the transaction being in credit, in the balance sheet of B debtors, who's that debtor here? A's name will be appearing in the debtors as 600 rupees. In the balance sheet of A, this will be creditors appearing amount payable to B at rupees 600. Is that clear? Now, sometimes later you are merging this, merging into AB, merging into A and B. While merging, the stock being 600 plus 500, 1500 will be shown here, stock. Is that clear? Sorry, 1100 rupees. 1100 rupees. Clear? Stock being 1100. Clear? And debtors being 600, creditors being 600, profit and loss being 100. Absolute merger. Absolute merger. Pulling of interest method. You know that the debtors and creditors are the same party can be eliminated as intercompany owings. We cancel by crediting the debtors and debiting the creditors, that will be eliminated. But after the merger, now the common head knows that how this is 1100. One item I have taken from A, one item taken from B, and B says it is 500 rupees, A says 600 rupees. How logically it seems to be incorrect. Only then we realize, oh, this is the goods from B. Okay, as per the B's account, it is only 500 rupees worth. Now A and B both merged means both the stocks becomes the stock of A and B. So hereafter, as per the trade parents, as per AS number 2, you have to value the stocks at its own what value? Market value or book value, whichever is lower. Okay, market value or book value, whichever is lower. So cost or market value, whichever is lower. So hereafter, this should also be rewritten to 500 rupees. That 100 rupees added by B now becomes a part of A's item, where these two are merged and the profit now remains unrealized. We have not realized that profit. When the profit is realized, once the asset goes up, the stock goes out of the entire organization, only then it is considered to be realized. In that case, after the combination or combining, the 100 rupees is subtracted from here, and parallelly it is going to be subtracted from here. Hereafter, the profit becomes 0, the real stock value being 1000. Okay, if these two are separate entity, B says I have made the profit. A says, yeah, of course, I purchased it for 600 rupees. Later, he sells it for say 650 or 700 rupees. He too realizes the profit. We never bother about that. On merger, these two entities become single entity. So how can I make the profit by selling to me myself? Is that okay? So actually, you just think over A and A's son and A's son friend. Okay. A runs a stationery mart, and A's son friend wants a note to be purchased from A's son. So A purchases for 100, adds 100 rupees profit, usually sells 200 rupees. So if A's friend, son's friend purchases from A, what happens? He has to pay 200 rupees. And he knows that A's son can get it cheaper. Naturally, what happens? Your dad running the stationery mart, you just purchase a book for me. And immediately he requested, and he now asks his father. Immediately, father is also very joyfully sells the goods, because his son is also joining his business, right? So you know, adds 100 rupees and he adds 30 rupees profit and sells it to A's son for 130. This fellow, you know, surprisingly, with the 130, he adds another 30 and sells to A's friend for his pocket money. For his pocket money. Now listen, the moment A transfers to A's son, A says that 30 rupees profit is there, and A's son transfers that to his friend. He says that I gain another 30 rupees. What is the overall profit for the family? 60 rupees. A is also happy because his son starts learning the business. B is also happy because he gets 30 rupees for his tea expenses. A's friend is also happy because he gets 40 rupees cheaper. So everybody is happy. Everybody is happy, right? Now what happens? He takes this note and tries to sell to his friend. And his friend says, I waited for so long and I was in emergency. I purchased from outside, sir. Now what happens? It cancel. Now automatically what happens? A son should approach A. Dad cannot be sellable. Take it back. Can he say no? To his son, it cannot be. So the amount what he says 30 rupees becomes unrealized. When it is going to be realized? The moment this note sold by a son to his friend. Until that period, it is not realizable because the note is within the same family. Within the same family means A to A son, this 30 is also not released, this 30 is also not released. The moment if the note goes to the A son's friend, automatically this will be realized for A as well as A son. Both can realize. That's why it is treated as unrealized profit for the whole. The moment the stock goes out of the entire organization, then it will be realized. Is that okay? Clear now? Just making a slight change. And A sells 50% out of this. 50% out of this. Only 300 is there. The another 50% sold for 350 or whatever the rate may be. He made a nice profit of say 50 rupees. Doesn't matter. Now on merger, what happens? Okay, stocks being merged. How? 500 rupees and 300 rupees, 800 rupees, and debtors A 600, creditors B 600 rupees, and profit and loss being 100 plus 50, 150. Line by line addition. Now, what about the unrealized profit on this 800 rupees, sir? The item held by B, 500 rupees, is at cost only. You no need to do any change. But item held by A, as per the books, is 300. But we are sure this will be actually transferred from B, where he adds 100 rupees for 500 rupees. But it's half. Definitely, this 300 will have how much profit? 50 rupees profit. Am I right? So he now subtracts that 50 and shows this as 750. That will be subtracted from this value, 100 rupees. Is that clear? So from this, it is very clear. Not all the profit on all the stocks transfer from B to A. Only to the extent of stock remains unsold in the hands of the transferee will be removed. That's why I use the term unsold, means unrealized profit on unsold stock. The stock remains unsold. If all the stocks are sold, no problem. This will be not having any adjustment. The stocks transferred from B to A remains unsold. Then all the profit will be removed. Only 50% remains unsold. Only 50% of the profit is going to be removed. If all the stocks are sold, forget about that. Usually, that unreleased profit and unsold stock is coming along with the intercompany owings. Okay, this will be is all about means unreleased profit, and parallelly we are cancelling this one also, right? So these two are usually coming as a single adjustment. Intercompany owings as well as unrealized profit both will come as single adjustment. Is that clear? C. A. If such stock is included in the inventory of the selling company, record the stock at its value, excluding any unrealized profit in the journal entry. Okay, selling company. If the such stock is included in the inventory. Okay. And if such stock is included in the inventory of purchase company, pass journal entry. So this entry will be passed. What is the difference, sir? That difference we'll see in the subsequent lecture. Is that okay? Whether the goods transfer from B to A or A to B, that also matters, right? Okay, clear? Now here, excluding unrealized profit. In this case, we are adjusting that in the goodwill or capital. So two scenarios we have. And fourth point already discussed, exchange ratio for issue of debentures, right? Where old ratio by new ratio concept is also explained. So I hope now you'll be able to understand the intercompany owings. We have three components: debtors, creditors, BR, BP, as well as loans and advances to borrowings. In case of BR and BP, if two values are given, lower of these two values will be taken. The reason I already explained, it's due to the discounting of the bill as well as endorsing the bill. Clear? And I think I have to explain the realization expenses concept. And this one also completed. Issue of debenture to whom? Shareholders. Either it may be equity shares or preferred shareholders, then it's a part of purchase consideration. Will be includable in the purchase consideration. If the debenture are issued to the debentures, then status is nothing but settlement of debt. It will not be part of purchase consideration also covered. I think all the values were covered. All the values are covered. All the adjustments are over. Clear? Yeah. Question number 7A. In this case, also consider the following are the matter. Gold Limited sold goods worth rupees 10 lakhs, including 25% profit on cost to silver. Silver Limited immediately accepted bill for 5 lakhs, leaving 5 lakhs unsettled. Gold Limited discounted Silver Limited bills for 1 lakh and endorsed 1 lakh to creditors. So out of 5 lakhs, 1 lakh is discounted, another 1 lakh is endorsed, remaining 3 lakhs remains unsettled. So BRBP cancel only to the extent of 3 lakhs. Silver Limited sold 60% of the goods received from silver. 60% sold. Then aggregate profit will be applicable only for the remaining 40%. Okay, I'll solve this illustration.